Great to see everyone. My name is Oleg Bibergan, and I have a couple of roles, kind of, I guess, across financial ecosystem. Pertinent to this topic today, I'm a partner at Kismet Capital Group. We're an entrepreneurial investment organization started out by Ivan Tavrin about 5 years ago, and we're one of the leaders of SPAC market in Europe. Specifically, we have raised 3 SPACs on NASDAQ, just shy of $800 million of total capital, and we have closed the first of these SPACs in a D-SPAC deal. Actually, last week in New York, we've hit the closing bell on Nexter's D-SPAC / transaction completion where is a $2 billion trade, which is now publicly trading on NASDAQ. So, happy to answer questions about SPACs and have a discussion around them and, what they are and what they can be used for, in context of tech companies. And then just very briefly, I'm also a co-founder of an S16 VC venture fund. We're a Founders for Founders fund focused on seed to Series A investment opportunities. And we're basically a community of more than 80 founders, mostly from Europe as well as Russia. And you can find us at our website at s16vc.com.
Great. Actually, I'm going to check that website out. I didn't know that myself. So my name is David Stewart. I'll check. Oleg, you can hear me okay now?
I can hear you well.
Awesome. So my name is David Stewart. I'm a partner at the law firm Latham and Watkins. One of the sponsors for this program, a long time with the other sponsors. Oleg and I have been working together for a long time. I lead the capital markets practice for the Latham and Watkins in Russia's CIS, and also as of the last 18 months or so, I have been leading on many of the more high-profile D-SPAC transactions where a SPAC group such as Oleg's merges with and takes public a target, and we often act for the target. So I also acted for Nexter's, Vertical in London, Arcit in London, Cipher Mining in New York, and have several more hopefully on the way if the market will hold. And the purpose of today is really just to have a brief chat about how SPACs are structured, how they help venture capital and young companies that otherwise might not be ready for an IPO come to the market, as well as mature companies that are genuinely considering an IPO versus a D-SPAC transaction. We can talk about New York versus London or Amsterdam, et cetera. And so we were supposed to be joined by a third speaker who is our UK partner in London, but unfortunately it seems we're having some technical difficulties getting him in. So I think Oleg and I will just carry on. And we can talk a little bit about Nexters or anything else. We would definitely welcome questions. I'm not sure how we get questions on this platform, whether you have to type them, ask them, but we would be happy to have questions.
Yeah, there is a Q&A functionality, and I will continue monitoring it. So guys, please feel free to ask questions, and we'll as we go along.
So I guess like, maybe it just makes sense to talk about what a SPAC is, and
sure.
Maybe give the economics and I'll give the legal briefly, and then we'll kind of go from there.
Sure. So, SPACs have been like a big thing in the capital markets in the past 3 years. And I guess the reason is that they offer a lot of flexibility compared to a traditional IPO route. To take a traditional IPO, basically what it involves is, the company needs to take time to prepare sort of well in advance. So, typically it's something that may take for a non-US lister, especially, anywhere between 12 to 24 months. And David and I have both been, involved in the transactions with like high profile companies that have taken, 24 months to basically list, even though at the outset of the process, it appeared that they were completely ready. So SPACs came in as a way to speed this process up and give it more certainty. the way SPACs achieve it is primarily through the following avenues. First, in a SPAC, you have a sponsor, and sponsor is basically the founder of a SPAC, who basically helps you prepare for the transaction to achieve it faster, to list faster, and with higher certainty. So, the profile of the sponsor of SPAC is just an extremely important decision criteria for, any company that wants to go down the SPAC route, because, that's, in a way, that's similar to taking, capital from a private equity sponsor or from a very high-profile VC. It's a very important decision who becomes a sponsor of your company if you choose to go down the SPAC listing route. The second way that things speed up along the way and offer higher certainty is the fact that in a SPAC transaction, the valuation of the go. So when you agree a deal with a SPAC, you know how much your company will be valued. Whereas if you go to a traditional IPO route, basically you don't know what will be the valuation, the final valuation of the deal, until essentially it starts trading. And the third and a very important aspect of a SPAC deal is that because of the way US regulatory structure is set up, in a SPAC transaction, a company can share forward-looking projections on its financial performance with the investors, whereas in a traditional IPO route, it may not. And it's particularly pertinent for high growth companies where most of the growth is still in the future, and the investors need that information in order to value the business.
Yeah, and I would just add to that I think that as a potential target, there are many important decisions to be made when you're thinking about whether to do an IPO or to do a SPAC, or possibly to do a private fundraise. And we have clients who pursue all three, including a potential strategic sale in parallel. We literally have presentations about the so-called quadruple track, where we act for targets as they uncover their different strategies for how to monetize their assets and their investments. I think the great thing about the SPAC model is that similar to an IPO, it gives you flexibility. You think about, do you want to be in New York or NASDAQ? Are you better in London or Amsterdam? There are different markets where there are SPACs listed, and you can kind of match your market to your business and where you feel that you'll get the best trade. Also, it's a product that fits all shapes and sizes. So if you need significant amounts of private money, if you need debt leverage, if you just need a little bit of equity and to get public to hit a multiple so that then you can raise future capital, there are a lot of different shapes and sizes of capital structures that can be satisfied with a de-SPAC transaction, and as long as you choose the right partner. And so what we always tell our target clients is that there are a lot of SPACs there aren't a lot of good ones. So it's very important to pick a SPAC with an extremely well-known sponsor, preferably someone with great experience in the space, someone who can bring credible board members, CFOs, lawyers, and advisors to help with deal execution. And if you can do that, then that's you could really have a high chance of success. Also, something that's very important is that if it is a capital-intensive business, is to find a partner in the SPAC process, an organization like Oleg's, which has either has significant capital available to commit to the process, or has friends and co-investors and potential future co-investors who can bring capital in the form of what's called a private investment, public equity, or even debt financing. So lots of things to consider, but the SPAC and the de-SPAC process is definitely an exciting alternative way, as Oleg said, to get to a quicker valuation, get more deal certainty, and then move forward towards your ultimate goal of being a public company.
Hey, David, we actually have first question come in from Lucas, who's asking how would we compare the cost of fundraising to the company, IPO versus SPAC? I think that's a great question. I'm happy to take it, and then perhaps you want to comment as well. So, I think this is a fantastic question, and the way to think about it is really in two buckets. The first bucket is the fee structure. The fee structure itself, right? On the fee structure, I would say that SPACs are somewhat cheaper. Now, to list in the US, you would be paying the bankers, paying the investment bankers anywhere between 5 to 6% of the free float, that being the listing amount that you want to make. In the SPAC world, actually, about half of that is paid by the sponsor on an IPO of a SPAC, because if remember, structurally, SPAC is essentially already listed. That job is already done, right? So all of the prospectus, all of that has been published, all of the SEC approvals have been secured, and so at least half of the way in has already been paid through, and you have a public company. And so where a SPAC deal technically encompasses, and David can talk about that as well, is merger of SPAC as a listed company and a private company that enters the public market through a SPAC. And so half of the investment banking fees, half of the legal fees are typically already paid by the sponsor in order to list the SPAC itself. There is a second bucket of fees, or rather, there is a second bucket of economics where the answer really depends, and that one is sort of a broader deal economics to the sellers versus the investors who are buying the stock, as well as the sponsor in the case of a SPAC. And I'll give you an example. So typically, when you have a process of listing via an IPO, the way this process works is that the selling shareholders, and the selling shareholders are private shareholders of a private company that is about to go public, leave on the table anywhere between, I want to say 15 to 30% of value. What do I mean by that? What I mean is that when you have a successful IPO, people consider a successful IPO where you have a first day pop in the stock price. Let's take a case of Headhunter, which was one of the benchmark transactions of this sort in Russia, out of Russia on NASDAQ. It's listed at, I believe the IPO price was somewhere between $14 a share. It finished the day at $17 a share. That's a great result for the market, for the investors who have purchased the stock at $14 a share, but it's not that great of a result for the shareholders of the company on the private basis who have sold that stock at 14 versus 17, right? So, and that's what's entailed as an IPO discount. And IPO discount is a real thing. And people can leave as much as 20 to 30% of value on the table because of it. So what SPAC route allows the companies to do is eliminate the IPO discount by privately agreeing the valuation with a SPAC, and then the SPAC basically markets that valuation to the market on as is basis, and it's a valuation that is then essentially set in stone in the transaction. Now, obviously, it may move together with the market, but at least the shareholders know that they have a fixed number they can expect. For example, if there is a cash out element in the deal. On the flip side, the SPAC deal involves what's called a sponsor promote, and sponsor promote is typically 20% of the SPAC size. And the best way to think about it is sort of like a sponsor carry, where you have akin to a venture capital or private equity fund, which charges a carry. So sponsor also charges like a carry-like instrument called sponsor promote. Like I said, it's 20% of the value of the SPAC. And the key is really to find the balance in the transaction in terms of the size of the company that lists via SPAC versus the size of the SPAC and the size of any additional investment, such as a PIPE on top of the SPAC, such that the overall sponsor promote is quite small. So to give you an example, in an Exodus transaction, the total value of our sponsors promote, when all was said and done, as as a whole of Nexter's valuation was around 2.5 to 3% from memory. Now, that's a lot less than 30% that could be a potential IPO discount. So on that side of the equation, like I said, it really depends. But I would say that overall, it's possible to make SPAC route materially cheaper than a direct IPO route.
I actually agree with that. I mean, I think that there's a bit of a hang up around the promote, when in reality it is a acceptable cost to pay to get a deal done. It's also sponsors really believe in the deals they're doing, and they're usually willing to align economics in a way where other things can be aligned with the founders, such that it doesn't create an overhang on the stock and everybody realizes better valuations early. I mean, from a pure lawyer's perspective, these transactions are complicated. They're genuinely two transactions. They're an M&A transaction, and then they're a public listing and preparation transaction, and it's a lot of work. But unlike an IPO.
Hey, David, we've lost your video and audio signal.
Yeah.
There we go. We have you back.
So unlike in an IPO, where you're constrained by certain comfort letter rules and other pretty hard deadlines, you have more flexibility in getting the deal done, and you have a partner who works with you and in the SPAC to really pull it together and get you public company ready. And this is particularly valued for smaller tech type companies who in a normal world might be doing a round B or a round C, and instead they're going public via SPAC, and they're capturing a multiple that they could only ever dream of otherwise. And so that multiple valuation plus the value of the SPAC sponsor and the wisdom and guidance they bring more than outweighs, and along with all the other points Oleg made, more than outweighs the cost.
We got another question from the group, which is, why have SPACs become so popular recently? That's also another great question. Look, I would say that there are a couple of main reasons. So one is, as with any asset class, and by asset class I mean, there are, let's say there are early seed funds or growth equity funds or private equity funds, and similarly with the SPAC world, there's just been a lot of capital in the market that are looking for ways to deploy that capital to invest, right? And that's really a tide that has lifted all boats. There are multiple reasons for it. Low cost of capital in the market. There have been multiple rounds of stimuluses, and it's generally speaking, the capital has never been easier globally across all developed markets than it has been for the past 5 years. And another way to ask the same question, I think, why are the SPACs popular, would be to if we look, as I have an experience in this as well, if we look at the early stage world, like why are companies being valued at 100 times revenues? Right, like where is there, how, why is that happening? And because it wasn't happening 5 years ago, right? So I think that's the reason in the timing. And I think as with any product, both tech product or a financial product, you go through a hype cycle, right? Right now we're actually in a little bit of a SPAC winter. So if you're actually considering a SPAC, a lot of people will tell you, and I will agree with them, that right now is not the best time. If you're ready to list today, SPACs are probably not the best option, because there's been so much SPAC issuance. There's been a bit of a SPAC fatigue in the market, and quite frankly, there have been some very questionable deals. Like when we at Kismet, when we see flying taxi companies being with zero revenues, with revenue projections for 2026. So the company is priced off of an unproven technology with a revenue to be hit like 5 years from now. Truly, we think this is what gives this is what gives the market a lot of concern, and we share the same concern. We think that over the long term, from a SPAC sponsor perspective, the market will always, separate the ones that are quality sponsors that do quality deals. This is what we espouse to do, versus, the sponsors that take flying taxi companies public that are clearly not ready to be public, right? And so we're just going through one of those periods of the hype cycle. We got one more question from Anton, or I don't know, David, do you want to add anything else on the popularity point?
No, I agree with that. I mean, the only point that I would add is I think it was deceivingly easy to get a SPAC IPO done for a while because investors chase yield, keep the warrant. So even if they don't support the deal, ultimately they keep the warrant, and that created some slightly upside down incentive for the investor market. But I think that we've all come to recognize that as we see high redemptions. Sorry, we can go to the next question.
Yes, our next question from Anton Fedorov. Hi, Anton. Is there a trend emerging of SPAC of sub 100 million, or it doesn't make sense? Look, I think broadly speaking, it's the same story as with any fund. The smaller the SPAC, the smaller are the resources that the SPAC can dedicate to a deal in terms of team, right? And then also the smaller the SPAC, the less free float you have. So the listing becomes sort of technical. So I would say, yeah, we think truly that the minimum should be around 200. I mean, our SPACs are around 250 minimum, 250 average range. And we think the sizes will probably go higher than lower going forward.
Yeah, I agree. I would agree with that. I mean, we do see there is a world, there is a small cap world, especially if you think about yourself as needing to go to possibly to if otherwise you'd be an AIM or a TSX type lister. But at some point, the cost of being on NASDAQ, the cost that it requires for financials and compliance, it just doesn't match to having a really small float for a foreign private issuer. You're better to wait and grow your business. I mean, the size of the SPAC is important, equally important, and this is a great thing about Oleg's team, is the size of their relationships where they can bring in pipes and other things. So, if you want to have a substantial pipe, you need to be a $1 or $2 billion plus company. Therefore, you can get pipe money, you get free float, and then you're going to have a real market within roughly 90 days of close by the time all those people are registered and trading.
We got one more question from Alexander. It's an interesting one. So merge with the SPAC, is it the final liquidity event for a particular company, or it looks like a preliminary step before a strategic M&A? Look, I think there is no, while the company is alive, even if it's inside some other company, think of PayPal, for example, right? There is no final liquidity event for that company, right? It can be bought, sold, merged, spun off, spun out. There are just so many eventualities, and I have been on boards of companies who have considered, for example, going public as a first step towards a strategic sale, right? And there are, David can tell of many companies that do, like you said, dual track, triple track, quadruple track deals where there are multiple strategic options being examined. So I would say it can be a final, and even with a SPAC, maybe just one more thing, right? Like once a SPAC transaction is completed, like our Nexters deal is now completed, there is no more SPAC, right? It's just a company. So it's just a public company. And so, liquidity events may be numerous. We may be, we now sit on Nexters board, and we may, in the future, we may do acquisitions that require financing, which will raise in the market. We may do convertible debt. We may sell the business in the future to a strategic. All of the options remain open.
Yeah, the only thing I would add to that is keep in mind a de-SPAC usually results in the founders giving up between 10 and 20% of the business. So there's still controlled companies. An entire world of options, just like any other company that's done an IPO. You're just on a multiple that is now a public company multiple. So yeah, the world is really your oyster. It is. It's hard to imagine the different types of things that you can do thereafter. And I think it's just and I should add, because I don't think either Oleg or I mentioned it. Not only is it get public, but as was the case with Nexters, it's also an opportunity to get monetization and liquidity for founders. So they can both go public and put cash into the business, but you also can cash out the founders. and then you live to fight another day, and you pick your next strategic move.
All right. So
I think
we have exhausted the questions from our group, and I guess we have 2 minutes left. David, do you want to make any further points?
No, I just wanted to thank you for joining us and sharing your point of view. For the viewers, I think Oleg has a very unique point of view because he's done IPOs in both the U.S. and London, as well as now doing de-SPACs. He's actually one of the few people in our entire market who I know who's actually done all those kinds of public market transactions, and he's a great resource.
Thank you, David. So I appreciate having me, and really great to go through this session. And I've posted my on my contact details. I guess people can reach me over email. I'll pop my email over here in our chat, and yeah, people can reach me over email in case of any further questions or ideas. Thank you.
Thank you all. Have a great day.
Thank you. Bye-bye.